Welcome. You're listening to The Best of Investing on Talk 910. I'm your host, Edward Brown, along with my co-host, Mark Hanf of Pacific Private Money, one of California's fastest-growing mortgage investment firms. And Patty Cohen is going to join us later on in the show. Our phone number is 888-912-1190. Use that number to answer the trivia questions for 3 vacations given away during this show. Vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. Those vacations are free. They're only a request a $75 cleaning fee to cover the housekeeping expenses. Today's trivia theme is miscellaneous trivia. Mark, we're going to get right into it. What do you got for us today?
Well, it's the end of January, Edward, and so a lot of the year-end figures are now starting to spill in. Some of the shows we were doing at the early part of January, we were talking about predictions for 2016, and we'll talk a little bit more about some of those. But what's interesting, as I said, so we've got some of this, year-end 2015 information sinking in and or filtering in here, and one in particular, which I follow closely, and we talk about this pretty much on a monthly basis here at the show, on the Best of Investing, and that is the Case-Shiller Real Estate Home Price Appreciation Index. And what I found interesting is that for the most part of 2015, San Francisco Bay Area home prices were holding pretty steady year over year at about a 10% appreciation rate. And we were talking throughout most of 2015 about the expectation that that rate of appreciation was going to slow down. And what would a normal appreciation feel like? 5-ish%, which is interesting. That's the national appreciation rate. Nationwide, home prices have been year over year up about 5%. Well, the year ended. Well, actually, it's through November because Case-Shiller there is a little bit of a lag time, but for all intents and purposes, I think we can pretty much call this the 2015 home price appreciation according to the Case-Shiller index, which is one of several indexes that track these values. Case-Shiller being one of the most popular. And anyway, it ended up 11%. So not only did it not slow down, not trend downward, it bumped up a little bit. So year over year, through the end of November, we were 11% higher in San Francisco. And, it's interesting, in their analysis, and they always have a little bit of an analysis section, they talk about how businesses in the oil and energy sectors are suffering, from the 75% drop in oil prices over the last year. And moreover, strong U.S. dollar is slowing exports. And, housing has been, the one really strong component of the economy, but the analysis suggests that housing is just not large enough, even though it's probably one of the largest components of the economy. It's just not large enough to offset all of the weak spots. And so we just had another meeting of the Fed this past week, and they decided not to increase, which actually was a surprise. I thought for sure they would bump it up another 25 basis points, 0.25%.
I'm glad that they kept it the same. I was a little concerned about the economy, and I think it was a very smart move.
Well, and if you're a real estate guy like we are, we like low interest rates. I'm still looking forward to refinancing one of my properties, and it's not quite ready yet for that. And I was holding out hope that mortgage rates would start spiking upward as I go.
They haven't, have they?
No, they have not. They're still right at 4%. And so we talked a little bit about this with Rob Spinoza on the show a couple weeks back, where we had that increase of 25%. The Fed raised the short-term rate in December. And there was a slight bump increase, reactionary increase in long-term rates, the 10-year rate, which is really the basis for the price we pay for mortgages. But that settled back down again because we're right now you can get a 30-year mortgage for about 3.95, I think is the average.
Awesome.
Yeah, so that's still a great rate. So another interesting little tidbit from the same article was the rent forecast for 2016. And again, looking nationwide at what, actually this is from Zillow, not from Case-Shiller, but Zillow released their rent forecast for 2016. And they are still predicting, even though they're saying nationwide, the quote-unquote good news is that the rate of increase for rents should be slowing down. Areas, the hot areas, such as the San Francisco Bay Area, if you're renting, you could probably still look forward to continued rent increases. Again, this is a blended average, but they're predicting by the end of 2016 that rents will be 6% higher than they are today. So not quite the 10% plus appreciation in rents that we were seeing in the San Francisco Bay Area.
I thought it was really interesting. I can't remember where I read this, but they were talking about rent control and how it's not very effective. And one of the reasons is because people who have rent control stay in their apartments. They don't want to move. So it's less inventory out there for new people coming in.
There's a lot of pros and cons. And of course, if you're a real estate investor, it's mostly cons. But
even if you're a renter, because if you're
if you're a renter, don't expect your landlord to put a lot of money in your apartment.
That's a huge part. But if you're looking for an apartment, all the other rents are going to be really high.
It's like, what, you got roaches? Oh, they taste good, chocolate covered.
Very good.
So, but interesting, again, it talks about for the San Francisco Bay Area, you're looking at, rents continuing to increase, maybe not quite as much as they have in the past, but the other part of the whole rent issue here in the Bay Area is that on average, according to the statistics, is that the average renter pays 40% of his income in rent.
And that's of his net pay or gross?
I'm assuming this is gross versus
that's
net.
Worse.
Yeah,
because you still have taxes taken out too.
Yeah,
that's terrible.
So 40% of your income going to rent, that also is going to constrain housing growth because part of the expected growth in housing is the conversion of renters from renting to owning a home.
Yep.
And when rents are as high as they are now, that puts a real constraint on people to do that conversion unless they get a great down payment gift from uncle or mom and dad. So again, these are all interesting aspects of the economy that kind of play into why there's so much concern about the direction we're going. We got decreasing oil prices. That's good for the consumer, but not good for other sectors of the economy. We've got continued appreciation in pricing, which is great if you own real estate, but if you're trying to get into real estate, how does that help? Wages, as we've talked about, they're staying relatively even, and unless you're working in the tech sector. So there's just a lot of unknowns there now, and so 2016. My own personal belief is that we're going to have a pretty decent year in the economy, largely because it's an election year.
Yeah.
And so, in election years, magic tends to happen that keeps the economy rolling. And of course, if the Democrats want to stay in power, they're probably going to do a few things here and there that from the presidential side that might keep that economy humming.
But a second-term president, because he has to leave,
right,
is a little different than if he was just trying to get reelected.
Definitely different.
Okay, so before we cut to a break, I want to ask you a quick question about. You're a lender, private lender.
Mm-hmm.
How do you approach, let's say someone comes to you for a loan who says, I want to buy a house specifically to turn into an Airbnb or a vacation rental by owner. How do you analyze that?
So that would be a business or investment purpose loan, number one, as opposed to a consumer loan. And why that's important is because there are different regulations on those two types of loans. And generally, there are just two types of loans from the eyes of a lender when it comes to how that loan gets underwritten and documented. Is it for a business or investment purpose, or is it for a consumer purpose? And a consumer purpose would be, if they're buying a home to live in as their primary residence, or they already own the home and they're looking to refinance it or pull cash out for a consumer purpose like debt consolidation, et cetera. Whereas pulling money out of your home to invest in other real estate to flip, that's a business purpose. So these are all things that in the new era of Dodd-Frank regulations that are intended to protect the consumer, these are important issues, and so we look at that. So if someone comes to us and say, I want to buy this home and fix it up and rent it out as an Airbnb, as opposed to renting it out to a family for, say, like $5,000 a month, they think they're going to get $15,000 a month on Airbnb. And in fact, in San Francisco, I know people who own rental property and those are the exact numbers. In fact, I know one family that they said they could get like $6,500 a month for this home, but they're making close to $20,000 on Airbnb. Now, it's a lot more work, right?
Yeah,
There are expenses against that. You have housekeeping and such, and you have to manage all of that, and you have to manage the website. So
And
there is,
worry about the regulations that are going on.
right.
with
So
Airbnb.
maybe maybe somebody in the family, one of the couple, is managing that, or they pay someone to manage that. So so it's not 20,000 versus 6,500 free, but it's still substantially more.
So how do you look at it as a lender? Though?
Well-
Do you put much stock in? I mean, like, effectively, it's like a mini hotel.
Well, when we're looking at the likely ability for the borrower to make those loan payments, and so while we might prefer a lease, an existing lease, or a signed lease contingent upon remodeling of the property, for example, would be one thing. And really what we're looking at when we make a loan, and most private lenders or hard money lenders, when they make a loan, they're looking at can the borrower afford the monthly payments? Do they have the income, either their existing W-2 income or other investment income? What's the likelihood that they can make that payment? The other thing we're looking at is depending on what loan to value they're looking at in terms of the loan. If they're looking for a 70% purchase loan, or is it maybe a 50%? So the more money they put in, the less concerned we are about how are you going to make the loan payments, because they're putting in such a significant chunk of capital that we're not worried that they're going to default on the loan.
Gotcha. Well, also, I guess one way to look at it too is if they're not successful doing Airbnb, hopefully they'll turn it into a regular lease.
And that's just it. If they struggle with Airbnb, or it turns out to be more work than it's worth for them, renting any home out in the Bay Area is not a struggle. So again, from a lender standpoint, we're going to look at that application favorably, assuming that it looks like the borrower has some competence, some experience, looks like he appears to know what he's doing. Maybe he has experience, maybe he owns other property. There's a lot of variables you can look at.
Give out your information before we go to the break.
So Pacific Private Money, we're at pacificprivatemoney.com. We are your alternative source for real estate financing. When the bank says no, we say yes. That's Pacific Private Money, and we're at pacificprivatemoney.com. Or call us 415-883-2150.
Okay, before we cut to the break, we do want to make a quick mention. Good old Neil Diamond tribute is going on February 5th, and tribute to Frank Sinatra is February 6th at the Lesher Theater in Walnut Creek. The price at the venue is very pretty, and the prices are very reasonable. So check out the Lesher Theater in Walnut Creek for Neil Diamond tribute on February 5th and Frank Sinatra on February 6th. So here's our first commercial break trivia question. Who was the first author to write a novel using a typewriter? All right, the first caller with the correct answer wins a free 3-day 2-night stay at the Lighthouse Resort. Call 888-912-1190 to answer that question. Stay with us. You're listening to The Best of Investing.
Okay. How long was that?
That was 1:45.
Okay, so we'll do a short second one, and why don't you ask me a question? Let's do one like, just thinking of it right now, that's a fund question.
Okay.
I'm thinking about investing your fund, but concerned about the size of it. What happens if your fund grows too large and you can't lend out the money? What will that do to yields?
Gotcha. So that could be an email question.
Yeah.
You've been having a good week. You know what? I've been praying for you. I'm serious. I pray for the company, you, your family. Just kind of.
Oh, that's,
Yeah,
appreciate that, Edward.
Yeah,
That's
just trying to
great.
keep the loans going. The
Glad you
integrity,
said that to
calm.
me, because that's,
Yeah.
every little bit helps.
It
Like,
does.
and knowing that sometimes helps alleviate a little bit of the.
Yeah, no, it's true, because I mean, I was talking to David too about it. I go, if anyone deserves it, it's you, because you work hard, keep your integrity high, you stay focused, try not to go to the left or right like that, and that's what successful people follow you.
Absolutely.
Okay. All right. Answer this, and then we'll get ready to your question here. Well, welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hanf of Pacific Private Money. First commercial trivia question we asked was, who was the first author to write a novel using a typewriter?
I have no idea.
Mark Twain.
Oh, is that right?
And he wrote
See?
Tom Sawyer.
I probably should have guessed.
Yeah, I was going to say that was not a trick question. It was one of those easy.
Tom Sawyer. I like the song from Rush, Tom Sawyer.
Oh, okay. Well, next time we have a music question, we'll ask
There we
that. Okay, so Mark, we got an email. It's kind of a long one, so I'll kind of just summarize it. Basically, it says, what happens if your fund grows too large? What happens to the yield to the investors?
Good question. So maybe that's someone who might be interested in investing in our fund and is wondering whether we'll be able to maintain the yields that we're currently paying.
Exactly.
So at Pacific Private Money, we have a mortgage pool fund that in 2015 paid out 8.2% to its members on a monthly distributed basis.
Non-leveraged.
Non-leveraged fund. So it is a what's called a 506 Reg D fund, which probably doesn't mean anything to many of you, but it's a very common format for the way mortgage funds are created and regulated. So we have grown our fund to just under 15 million in the last 3 years, and we're looking to grow that fund to 50 million, assuming that we continue at the pace that we've been raising capital. We believe we'll be there in approximately 2 to 3 years. Contrast that with the volume of loans that we originated at Pacific Private Money in 2015, and that number was 70 million, approximately 150 loans. We did a little over 150 loan transactions for a total of $70 million. Now, not all of those loans were funded by our mortgage pool fund. In fact, our mortgage pool fund wasn't large enough to be able to accommodate that loan volume. So we made the loans, the overage, we made those loans available to our high net worth individuals who like to invest in individual notes, which is also sometimes known as trustee investing or note investing. And depending on the appetite of the investor, some have a preference for investing in either a mortgage pool fund because they don't want to have to compete and study and look at individual notes and drive properties and read documents and all that stuff. They just want the 8% yield. And then there's those who they like the control. They actually, maybe they're full-time note investors, and many of them are. So depending on your preference. And so to answer the question about what happens to the yield as the fund grows, well, we believe that number one, our goal is to grow, and we at Pacific Private Money we have been growing. We did 60 million in 2014 and 50 million in 2013. So we've been growing at approximately 10 million annually in new loan origination. And so our goal for this year is actually more than $80 million. We're looking at growing upwards of 100 million with our sights set down the road for being 150 $200 million fund. Probably not B for probably not going to use the B word here, billions, but there's a size at which I feel that we would be comfortable in our growth attainment. But when it comes to yield, we believe that we will continue to grow and see a growth in loan demand for privately funded loans, ones that can be funded quickly and painlessly. And again, because of Dodd-Frank and the new stricter banking guidelines and lending guidelines, I don't see that ever turning back the tide to the easy money days of 2005. I just don't see that happening in my radar. And so I believe our business model will be sound for years to come.
It reminds me of when the stock market crashed in 1929, the margin, people could do 10 to 1. They realized, the Fed, or let's say the governing bodies realized, what, that's way too risky. The most we'll let someone leverage is 2 to 1. So you can buy, $100 worth of stock, let's say for $50 and borrow the other 50. And that hasn't changed since 1929. So there's some things that probably won't go back because it's too risky, and that's, I think, what you're talking about with regard to the lending guidelines that in 2005 just made it too easy to borrow.
Right, and so when we talk about, what type of yield do we believe we're going to continue to pay our investors, you need to remember that past performance is not a promise of future results, but we believe at Pacific Private Money that we will continue to be able to pay our investors a yield in the 8 to 9% range with a target somewhere in the middle 8s, certainly for this year and in future years, I believe that that it will stay consistent. Only because if anything, interest rates are going to gradually increase over time. Number one, and number two, we believe our deal flow will continue to increase. We think we will continue to see more and more loan applications for short-term bridge loans and other types of financing products. And so therefore, as our fund grows to 20, 30, 40, 50 million, we believe that we're not going to struggle with deal flow. And I will tell you that there are two components to being a private lender like Pacific Private Money. One is deal flow, how many loan applications do you get on a daily basis, and the other is capital. Where do you get your capital from? Yeah. So, and we've been able to maintain a very good balance over the years, and we've been around since 2008. So we're looking at our 8-year anniversary coming this spring, and we've always been able to maintain a really close balance between access to capital and how often the phone rings on a daily basis.
Also, if somebody wrote you a large check right now, it's not like it would go into the fund working immediately.
Right, new money doesn't dilute the fund. New money waits on the sidelines, earning nothing until we have new deals to fund. And so that might take as little as a few days to we've had an investor at one point had to wait 6 weeks for his money to go to work. Well, 6 weeks might seem like a long time, but you're not getting anything in the bank anyway.
And once it's in,
it's in. And
yeah.
now he's thrilled that he's getting 8% on an annualized basis on his money. So he didn't mind the wait.
Very good.
For more information, our fund has its own website. It's pacificmoneyfund.com, pacificmoneyfund.com, or call us and we'll send you some information on how the fund works. 415-883-2150.
I think one of the things I appreciate about it too is the average loan to value in the fund is less than 60%. What is it now?
It's 55.
55%.
Just working on the January figures right now.
So you've got a fund that is unleveraged, that is 55% loan to value, and you're paying net to the investor because of no fees to the investor of over 8%.
Yeah, 8.2 as of the end of the year.
And why don't you tell the audience right now who maybe have never heard this before? Let's say I'm in the fund, but I want to get my investment back for whatever reason.
Well, our business model in our fund, unlike many other funds, is we do short-term loans. We favor our portfolio of what's currently 55 loans is mostly short-term loans that will pay off within a year, as opposed to mortgage pool funds that are making fully amortized 20 or 25 or 30-year loans. We have a lot of liquidity. So, like for example, this week we had about $1.2 million in cash in the account. So we've only had to handle a short number of redemptions, and they were done almost immediately. So the redemption. Now, if there's a run on the bank, so to speak, something horrific happens. Obviously we're not intended to be a liquid fund because most of the money in the fund is tied up in real estate secured loans. But assuming that real estate market doesn't move that quickly, that there'll be an opportunity and a strategy for being able to liquidate those loans over time. But assuming that the economy goes as we expect it to go over the next few years, even with the cycle in the real estate market, the fund is designed to be more liquid than most funds, and that we don't expect it to be to take long to redeem someone's membership.
Okay, so when a loan pays off, then you go ahead and look and see who wants to redeem first,
right.
And then which I know that can also kind of limit your growth, but I think you're going to have a lot happier clients.
Absolutely.
On that.
Again, for more information, go to pacificmoneyfund.com.
Any specific deals you're working on? Because I know that the audience keeps going. I wonder how they're getting 8%.
It's funny. My guys are crazy busy this week. I actually had to fly out of town to a conference end of the week and didn't get a chance to sit on the end of week loan pipeline meeting. But we have, I'm told, about $10 million in loan applications total, and that was after a fairly slow, mid-December to mid-January. Our firm, as well as others who I talked to, were all saying about the same things. Right around December 15th, phones stopped ringing and the deals kind of stalled. And then right around January 15th, all of a sudden, everybody wanted to close like tomorrow. So it got pretty busy. So we're continuing to see, Edward, a mostly people who need to close quickly. Short-term bridge loans for people who want to buy a home now. And sell their existing home later. Those are the ones that we're mostly seeing. I mean, we got a couple of, there's always the odd ducks. We got a vineyard loan application there that's a refinance of existing private debt. We've got a bunch of applications for seconds, which we take a very hard look at if we like it. If there's a lot of equity in the property, oftentimes we'll go ahead and green light those. Those are usually smaller loans. They make up a much smaller portion of the fund portfolio, usually less than 10%. What's interesting is the hard money loans of 10 years ago. We don't make those borrower in distress type of loans. It's if there's a distress, it's a timing issue. It's like I'm going to lose my deposit on this home I want to buy now that the bank told me they can't close on time. Can you help me?
Well, I appreciate
we do that a lot.
You're not taking undue risk, which is very important.
Right.
Any last words before we let you go?
Give us a call, 415-883-2150, or visit either of our websites for information about our fund. Go to pacificmoneyfund.com, and for general information about how you can get a fast and easy bridge loan, our brokerage website is pacificprivatemoney.com. Both websites will take you to the other one. It doesn't really matter. You can even go to markhanf.com and get my book for free and other cool things. So I got all kinds of websites out there.
Excellent.
It's good to be ubiquitous.
Yeah, fancy word too. And don't forget to check out our friends at Pacific Trade Exchange is what I'm trying to say.
Yes.
The barter-to-barter business. You got to check them out if you're interested in doing some bartering. All legal, and these guys are pretty good. Brian Capehart's a decent guy there. All right, here's our second trivia question. Why does the interstate highway system require at least 1 mile in 5 to be straight? So 1 out of every 5 miles has to be straight. First caller with the correct answer wins a free 3-day 2-night stay at the Lighthouse Resort. Call 888-912-1190 to answer that question. Stay with us. You're listening to The Best of Investing. We'll be right back.
You gave me 2 extended segments there. I kept thinking you were going to cut me off there, so it's good.
No. I wanted to make sure you caught your
Yeah.
Okay, so let me do.
Well, I don't want to shortchange the other guys either.